What is up, YouTube? Matt McKeever. It's been a while since we did a live. I hope you guys are doing well. I took a month off from doing lives, but if you guys are watching this, give me a thumbs up. Let me know you can hear me in the comments, because although we took a month off from doing lives, I'm back doing it, but today I'm actually doing it by myself. Peter's on the road driving to Ottawa, so I just need to make sure you guys can hear me before I jump into my entire spiel about what we're going to be talking about today. So just let me know in the comments if you guys can hear me. But today, what we're going to be talking about is the Canadian real estate market. I'm going to give you guys my update on my opinion in regards to where the market's maybe going to go. Now, obviously, no one has a crystal ball, myself included, so I'm not claiming this is guaranteed to happen, but I thought I'd walk you through the framework of my mindset, at least in regards to what's going to go on in regards to the Canadian real estate market for the rest of 2021, seeing how we're about halfway through the year now, because July 1st already came and went. So that's wild to think of in and of itself. But also, I wanted to give you guys an update on what's going on with some changes to the CMHC rules. So if you guys didn't hear recently, just yesterday, in fact, CMHC came out with some new guidance. They're going to be tweaking some of their rules. So I wanted to cover that as well. But let's really focus on big picture, what's going on in the Canadian real estate market. I'd love to hear your thoughts, your opinions, as well as let me know what market are you investing in and what's going on in the day-to-day local trenches of your market. If you guys haven't seen, we're starting to do a lot more videos with different realtors discussing every month the stats and what's going on in their market so that you guys can have a better perspective of the boots on the ground. Now, today we're going to take kind of more of a high level view of things, but if you'd like to see me do a separate breakdown, getting really deep into granular details of why I think the Canadian real estate market isn't likely to crash, and spoiler alert, I don't think it's likely to crash, but again, no crystal ball here, but let's walk through my logic, my thoughts. And I'd love to hear your opinions on what you're seeing going on in your local market, because definitely in Southwestern Ontario, I'm hearing from lots of realtors that the market is catching its breath. Maybe it's even cooling off in certain markets, but it definitely doesn't seem to be plummeting. But there's been a lot of news going on in regards to what's going on in the Canadian economy, real estate, and all that. So the four big factors I want to hit on today is inflation, banking rules and CMHC rules and the changes to CMHC, core development. So if you guys didn't hear about core development, big company coming in, plan to drop $1 billion on Canadian residential real estate. I'm going to share my opinions and some insights there. And then finally, also talking about money laundering and the impact it has on Canadian real estate. And when we look at all these factors together, I start to think that we're likely to tread water or even maybe continue to see prices increases, as crazy as that sounds. But first, let's talk about inflation. So here's I thought just a quick reminder of where inflation has been in the past. So remember the 80s, maybe you remember hearing your parents talk about how crazy inflation was, how crazy mortgage rates were back in the 80s. Well, just a reminder, according to like the government stats on what inflation was, it was a lot higher back in those late 80s, early 90s than what we've experienced in recent memory. And again, I thought this was even fun just to look at over 100-year timeline. So from 1915 to 2020, but again, none of this stuff really impacts us today. What I want to discuss with you guys is what's going on, boots on the ground. So we've done multiple videos in regards to inflation here, particularly in regards to input costs. So building costs, right? Lumber, insulation, windows, appliances. Either things are getting more expensive, they're harder to find, or both, it seems like these days. It's very hard to find anything where you're really saving money from an input cost when looking at doing renovations or building a house. Certainly labor has not gone down in value either. If anything, it seems like it's harder than ever to get people like general laborers, particularly the prices that you likely were getting them pre-COVID, pre-pandemic. So anyways, Stats Canada recently came out with their annual pace of inflation in April rose to its highest level in nearly a decade as gasoline prices posted a record increase. So again, we're starting to see some now headlines, some notes of inflation, but I honestly don't think that we're really starting to see it represented in a lot of government statistics yet. Anecdotally speaking, my Peter, who lives in the house with me here, he has always this flyer from the butcher shop that he buys his meat from on the fridge of the fridge in the kitchen. And anyways, I just happened to notice over the last 6 months, they've done 3 price increases for the cost of beef. And I don't think that beef is the only thing that's seen those increases. And again, as we continue to see the input costs around housing increase, it seems understandable that you would eventually see that, spilling over into residential real estate and into, rental properties and just like real estate prices in general. So just wanted to share that the annual pace of inflation was 3.4% in April. Again, I suspect that we're going to continue to hear more and more headlines like that. Now, maybe you guys are bored of me talking about this, and I'm kind of in the way here, but I've shared this multiple times, just looking at the Bank of Canada's assets and liabilities, right? So looking at the Bank of Canada's weekly, this was formerly the B2. And just a reminder, this is looking at a span of maybe 25, 30 years. You know, we have that little blip back in 08, 09, kind of 010, right? When kind of the Great Recession, is that what we were calling it back then? And then we had COVID, where it literally just the bank's assets went to the moon. And now I understand some people will say that this doesn't directly impact inflation. This isn't necessarily going to directly see its way into the market. To that, I say, I'm not sure I believe you, although I think I understand the arguments there. I really see a lot of just cheap money sloshing around in real estate, well, sloshing around in the markets right now. It's chasing anything and everything, whether that's stocks, whether that's crypto, whether that's real estate. I think the one thing that in general, from my opinion, my perspective, and you guys let me know in the comments, that I'm seeing is that money doesn't want to just sit on the sidelines. It wants to go out there and earn a return, because right now, assuming that inflation is where a lot of us maybe suspect it is, you don't want to be sitting on dead money if your money's losing its value, you know, minute by minute. Maybe it's not quite that bad yet. And then let's just look at the Canada New Housing Price Index. So again, this isn't a very long period of time, just comparing from May 2020 to essentially May 2021, we can see it's 116 cents on the dollar, right? Or 116% of what you would have paid back in May. That's a crazy inflation rate. And again, we're going to get to just general real estate, but I believe RICO, the Real Estate Council, or not RICO, the National Realtor Organization. I don't know why I'm drawing a blank there, but anyways, the National Realtor Organization, I'm pretty sure they posted at 24% year over year for real estate prices in Canada, May 2020 to May 2021. But again, we'll get to that in a second, which again is just wild. And then finally, if you just want a snapshot of what's going on in the real estate market general, before I dive into some of my more deeper perspectives on what's going on when it comes to Canadian real estate and why I'm still kind of bullish from a price perspective. Again, that's not saying you should just blindly jump into real estate. I think that it's more, you need to be more careful and run your numbers. You need to run your numbers more carefully than ever before as a real estate investor. If not, you're doing yourself and you're like anyone that's lending to you or any of your silent partners a huge disservice, because it is a very competitive market out there. I think it's very dynamic. Prices could go sideways, they could go up, they could go down. But as long as you're investing for fundamentals, hopefully you can, you know, weather any roller coaster. And that's why I really always love focusing on the fundamentals of getting cash flowing rental properties. But let's move on from inflation and let's just quickly touch upon the CMHC mortgage rule changes. So if you didn't hear, you know, last year, essentially CMHC tightened the rules. Also, remember when CMHC predicted that real estate was going to drop by like 9 to 18%? Yeah, that I don't think that played out the way they predicted. But anyways, I'll do a whole separate video on that. But essentially what's happened here is your gross debt service ratio, they've given some leniency here. So it's being reduced, sorry, is this the right one? Okay, so where is it? The maximum gross, yeah, so we're back to the 39% that originally was reduced to 35, and we're back to 44. So that wasn't actually what I wanted there, but anyways, that is what the rule changed to. But I thought that Ron Butler here had a really cool thread. If you're not following him, he's Ron, the mortgage guy on Twitter, but essentially breaking down his perspective in regards to, you know, what's going on with Canada's real estate. He's always got great opinions, but particularly when it came to CMHC. So, you know, was anyone in government thinking about runaway house prices? Just one guy that I know of. During his term at CMHC, Evan changed a lot of things. Ending CMHC's cheerleader status was one of them. He saw CMHC's role differently than his predecessors. So no more expansion of CMHC, better to target key housing issues, and most important, worry about mortgage debt levels and possible downturns in the Canadian real estate market. Above all, CMHC is an insurance company, so risk should be front and center. When COVID hit, that was risk. Rationally, he worried about the effect on the real estate market, and he was a key leader of mortgage deferral. When he saw real estate prices take off at the end of summer 2020, he made debt ratio adjustments and moved to limit risk. It could have been a partial break on crazy price increases. So yeah, prices could have technically even got crazier. Now, obviously, CMHC is only going to be impacting insured mortgages. So this is just a percentage of the market. This is primarily going to be, first-time buyers, people that are buying their principal residence. But still important to have that perspective of just understanding that, like, this is one catalyst or one break in the real estate world in regards to prices and demand. But the DOF, the Department of Finance, wouldn't make it universal for all mortgage insurers, so lenders just switched to other insurers. So this is essentially one of the reasons why it sounds like CMHC actually ended up changing their policies back to the original rules, is they were losing market share. And now I think, there's something concerning about hearing CMHC saying they're changing their policies because of market share. But at the same time, I do understand that it is, a corporate entity that does need to, maintain its market share, or if it eventually loses all of its market share, it becomes completely irrelevant. So outcomes are not always obvious. Holistically, Evan was right. Canadian real estate prices took off, and so did mortgage debt. Currently, they are at peak levels. Is there risk? Clearly there is, but certainly of disaster today or ever. But there is, but no certainty of disaster today or ever. The cautious are not always rewarded. And so, I think that's important to just understand. These CMHC rule changes, I don't think they're going to have a huge impact. I don't think they had a huge impact in September. But if anything, this is probably just one more little catalyst to a spark to our real estate market. So if anything, that's probably a bullish sign when we're talking about the changes to CMHC, talking from a pricing perspective. That may not be something you enjoy, but this is a much bigger story that was across all the major newspapers. Core Development. So if you weren't paying attention, Core Developments announced that they're going to be dropping, up to $1 billion on single family housing over the next, I think, 3 to 4 years. And the company said it intends to buy up to 4,000 homes, and I think even 2,500 homes just in southwestern Ontario over the next few years, but 4,000 rental units in Ontario, Quebec, BC, and Atlantic Canada by 2026, as first reported in the Globe and Mail. So corporate investors like private equity firms, real estate investment trusts, REITs, financial institutions have become increasingly large presences in Canada's multi-family apartment rental sector. Investment strategy focused on turning single-family homes into rentals. While already common in the U.S., it's thought to be a first in Canada. If it's profitable, experts say it will likely invite imitation from the corporate real estate investors. This is definitely a very tried and true model almost at this point in time in the U.S. Blackstone, BlackRock, all those. And they're not the only ones. There's a lot of different large institutional buyers when we're talking about U.S. real estate. And I think that we're going to see this trend really start to pick up in Canada for a multitude of reasons. But I think core is maybe just the first canary in the coal mine. But here's that stat that I was mentioning earlier. Home prices were up a mind-boggling 24% year over year in the CREA, that was the organization I was trying to think of, the Canadian Real Estate Association said on Tuesday. So jumping over here just to stories, they had just another little thing that just broke down the different cities that Core's actually been already purchasing in. I think this is important for us to know, particularly if you're in southwestern Ontario as an investor. So they started buying properties in Cambridge, Hamilton, Peterborough, London, Barrie, Kingston, St. Catharines, and will soon drop more dollars on properties in Guelph. I mean, right now, the only market that we're not wholesaling in is Kingston. So I don't know if that's great minds think alike or what, but I understand the draw there, right? It's the same draw that small investors, probably you guys, my audience, myself included, the reason we're drawn to those markets is you can still actually cash flow. And we're going to get a little bit deeper into Core's business model in a second. Again, I think I'll shoot a whole separate spin-off video on this and we can go even deeper into it. Let me know any questions or any areas you'd like me to cover in more depth in a future video. But let's just go through this quick. So if we accept, and this is from Stories again, if we accept that the huge run up in real estate prices, 50% in 12 months in some Ontario regions, 50%, is particularly driven by a severe lack of supply, the idea of corporate buying up 2,500 homes in the next couple of years further impairs supply, making it even harder for first-time home buyers. And that fact is starting to become a problem for the future of our country, says Ron Butler. Ron, who we were talking about earlier on Twitter, owner of Toronto Butler's Mortgage. Any reduction in housing inventory eaten up by a corporation works against first-time home buyers. So, if there's more people competing, naturally there's going to be more demand. That should create a more stable floor or pressure on the floor of prices, which is going to push it up. Now, Corey Houghton, who's the founder of Core Developments, argues, but we have really strict buying parameters, and we will never outpay the end user just because we can. Buying a home becomes an emotional experience, and we appreciate that. The types of homes we're buying are in a state of disrepair, and a lot of bidding wars don't seem to happen around those homes. If we notice one's attracting bidding wars, we just won't participate. Now, I think that's probably an oversimplification, but I can understand the position he's in. I imagine they're still going to participate in bidding wars. I imagine what he was trying to say here was really just that, like, they're not going to be purposefully driving bidding wars, and they're not just purposefully outbidding people. They're going to follow a very strict business model, but I imagine that if the business model tells them to get into a bidding war, that they will, unless they've got a direct rule around not doing so, which I'd find shocking. So again, I see this as definitely creating a lot more demand, but I think the bigger question here is, will this drive even more businesses to enter this space? I suspect yes. Again, I think that Canadian real estate is a very desirable asset class for a variety of reasons that we've discussed multiple times on the channel that I won't go super deep into right now. But I just don't see what's going to be the catalyst here to really change those things. But I'd love to hear your thoughts, your opinions. If you're currently waiting on the sideline, expecting a correction, what do you think is going to drive it? Do you think interest rates are going to change? Do you think people will just stop wanting real estate? Do you think Canadians just have too much debt and we literally can't afford to keep paying it, or we can't afford to take on more debt? Let me know in the comments, because I am really curious in your opinions. But here's a thread from Shane Digman. I think he's Globe and Mail, if I remember correctly. Yeah. And so this was him just kind of breaking down Core Development's business model here. So this plan from Core to spend $1 billion or more on houses, not apartment buildings, to rent out follows a pattern seen in other countries. As my colleague Rachel Youngley writes, it's a tried and true strategy for another Canadian firm, Tricon, that buys houses in the US. High demand, high prices, few vacancies, and it's hard to build. So developers becoming a house landlord. Yeah, and those are a lot of the issues, right? Like, if it was actually easy to build, if it was cheaper to build, right? I think, and a lot of this comes down to zoning and planning, and you can't just snap your fingers and change those things. But I think long-term, we're really going to have to loosen things like zoning restrictions and building restrictions, and even like, allowing people to have higher density zoning or higher density like living units within converted dwellings, right? That's what's really going to drive more inventory, in my opinion. Again, hopefully this isn't just going to seem like a hit piece on Core, because I'm not, but just talking through it from, is this going to impact the Canadian real estate market? I think long-term, yes, because I think we'll see additional entrance into this market, and more people buying more real estate would imply that you're going to see higher prices. The assumption this plan rests on are simple. The housing crisis has grown so acute in Southern Ontario that it makes financial sense to pay top dollar for a bunch of homes and rent them out, because you're going to be able to outbid middle-class folks who might want to buy. Rents for detached homes aren't out of reach now, but the bet is that if rents will rise, and this plan actually exacerbates that, because they take thousands of ownership homes off the market, increasing the premium for buyers. If you outbid buyers, they might become renters. Win for Core. If prices go up because there are fewer ownership homes in the market, that's also a win for Core. Portfolio more valuable and larger pools of hopes dashed for buyers. Upgrade marginal homes also cheaper for Core. Rentals at scale equals big win. A final note, yes, rents for detached in Toronto are quite high, but Core seems to be planning on buying in bedroom communities on the assumption that Toronto will continue to price out owner-renter hopefuls, pushing them into Core's arms in the GTA and beyond. Yeah, I think that that's a pretty reasonable breakdown there, or analysis of the situation. Again, this is just a business reacting to market factors, right? So I'm not coloring it with a negative or a positive brush, but I do think that this will have consequences. I think that they're looking at a lot of the same fundamentals that we look at, and yeah, hey, it makes sense. Jumping over to another Twitter thread here, a quick thread on why funds like BlackRock are in bidding wars for your grandma's single-family home. Let's try something different. Pretend you're an institution. I'm going to pitch you on why you should consider buying a home, or 100,000 of them. Oh, let's get this little thread open here. So let's start with your pre-Great Recession days. You were investing in bonds, booking 5% fixed income returns, and doing mountains of coke. Things were awesome. All of a sudden, the Great Recession happens, interest rates plummet, and you can't make any money lending cash. What happened? Well, credit markets are based on supply and demand. And when more people want to borrow money than want to lend, interest costs rise. If more people want to lend, money than borrow, interest costs fall. Bad environment equals no one lends, everyone needs, high rates. Good environment equals everyone lends and no one needs money, low rates. That's how free markets work. It chokes off capital when the risk occurs and frees it up when it leaves. It's naturally regulating. Central banks hate free markets, though. Things only go up or else. 100% agree with Steven here. So don't worry about this. This is about real estate. In a downturn, central banks normally cut interest rates, and when they're down to zero interest, they deploy something called quantitative easing. This is when the central bank unleashes an unlimited amount of money to push yields down. Chillberry, we aren't I don't know what that is. The fact is, when a central bank floods the market, yields get crushed. Since the credit markets are competitive, borrowing rates generally fall across the board. You're stuck. What do you do now? Accept yields lower than inflation or look for an alternative? Obviously, you do look somewhere else. That's why fixed income allocation went from 50% in portfolios in 1990 to 30% in 2019. Alternative assets went from 7% to 29% over the same time. I thought this was just a really, I haven't zoomed in too much, but I thought this was a great little chart just to look at, just to see the breakdown of how that was in regards to state and local government pensions and endowments. And yep, we can see that there's definitely been a change in allocations of their assets. So low rates do three important things, and this is important for all of us to understand. They lower the cost of borrowing. You can borrow a fuck ton for cheap. And when we're looking at these corporate entities, they can borrow a lot more than we can as small investors. And so I think that's going to lead towards a lot more debt sloshing around there, chasing after the same real estate. Again, I will do a separate video on this because I think this is even deeper than we're going, or like there's more than what we can do here. But it increases the debt households can access. That's also important. This lets home buyers absorb higher prices, and it crushes your fixed income. What's your obvious move? You take your massive amounts of capital and start scaling homes. Apply pressure to the housing stock and look for yields higher than bonds. People keep saying institutional investors only represent a small amount of housing stock, so they can't impact prices. Nope. It would be true if you were buying homes anywhere across the US. You're not, though. You're chasing higher yields. You're not buying a single family home in New York City to get a 1.37% yield. That's still below inflation. So you zero in on higher yield markets. The inflation target's 2%, so you'll need at least that. So you want Charlotte, Phoenix, or Atlanta. I'll admit it's getting a little crowded in Atlanta, and this is a great chart as well for us to check out to see what's going on already in the US. But Atlanta, the share of single-family homes bought by large institutions from 2019 to 2020 in their most active target markets, more than 14%. I think that's narrowing in on 15% in Atlanta of all the homes purchased were from these institutional investors. And again, we can see there's multiple markets above the 6%, right? We've got Phoenix, Dallas, Nashville. And again, even just looking like above 4%, or how did I get that wrong? I guess there must be other cities in there. I'm not sure what that's all about, but yeah. Anyways, just very interesting to look at because seeing that Atlanta can have 14% of its market acquired by institutional investors, that can definitely, at least in the microcosm of the Atlanta market, put a lot of pressure on it. So I don't think I've got, I in theory have all the time in the world, but I think we're going to keep moving on here and we'll cover all of Steven's thread in a future video. But again, you guys can just go jump over to him on Twitter. This isn't something brand new, though. Like we've been seeing more and more articles in different newspapers and examples of institutional investors, partnering with developers, starting to get into different types of investments. In fact, I just thought it was kind of funny. When I was Googling to have this conversation with you guys, I found this McLean's article from back in 2005 talking about how Canada's a rising star amongst international investors and how that trend is likely to continue. I'm from the future, McLean's. It totally did continue in a big way. Again, big money bets on BC rentals. Good news for investors, worst fear for residents. So this is from the Vancouver Sun, and that's from a year ago again. And then here was just kind of an interesting white paper if you guys wanted to read more or maybe read one of the opinions on why housing is a great investment opportunity or why some people think it is. Again, not saying you should get into it, and no one's got a crystal ball, but here's one from a fellow Canuck. I think he's out in BC. Housing the best investment in history. So that's Benjamin Felix wrote that. And moving on now from talking about core developments, let's talk about the last thing, and then I'm going to try and knit this all together for you into why I'm still kind of bullish on Canadian real estate. Let's talk about money laundering. And again, regardless of what goes on with just retail investors, I think that we're going to see money laundering continue to be a factor in Canada's economy, whether you like it or not. So this is from Rika. So the results of May 2019 expert panel on money laundering in BC real estate suggest conservative estimates of 46.7 billion was laundered in Canada in 2018 alone. And that is expected to kind of be on the lower end of things. So I think that, entities like the International Monetary Fund, they've had estimates that peg the country's money laundering to be as high as 100 to 130 billion per year. Again, think about if we're talking about core development having $1 billion to splash around in a handful of markets, the impact that potentially could have, again, as we continue to see more competitors move in. Well, obviously, if there is $50, $100 billion in real estate that's being used for money laundering purposes, that's going to put pressure on our real estate market as well. And here's another Maclean's article, a more contemporary one. The gush of ill-gotten gains into the economy is deeply troubling. An expert panel set up to examine money laundering influence on BC's real estate sector conservatively estimated in its report 46.7 billion was laundered in Canada last year. Of that, the panel estimated that transactions in BC accounted for 7.4 billion. All that shady money pushed up home prices too. The panel cautiously estimated that property prices are 3.7 to 7.5% higher than they would have been without the effect of money laundering. That's for the province as a whole. The figure would be higher in markets like the Greater Vancouver, where the money laundering activity is actually concentrated as well, right? So again, just acting in the general broad economy, they're estimating it's 3.7 to 5 or to 7.5%. Whereas in very concentrated markets, right, you might be looking at a specific neighborhood, whether that specific neighborhood has money launderers or core development, or even just your friendly neighborhood investor, that can have an impact on what's going on from a pricing perspective. And if you guys are interested in learning more about money laundering, what's going on in Canada, I can't recommend enough Sam Cooper's book, Willful Blindness. In fact, I've already bought over a dozen copies of these just to give away to team members and friends. So again, highly recommend you guys check that out if you're a fellow Canuck. But let's now talk about how I'm going to kind of stitch this all together, hopefully into a cohesive point. But before I do that, let's see what you guys are saying in the comment section. Awesome. Appreciate the love. David, Sally, Tanya, Steven. Someone saying there's a 3-bid. Steven saying, I think it'll stay sideways for now. Prices will not increase, but inflation is what will keep prices flat instead of down. David's asking if I'm bullish on Alberta. I'm generally bullish on anything with good fundamentals. So depending on what you're investing in Alberta, I am bullish. Mark saying with the prices of materials going up, as is labor, and Canada still growing in population, I don't see this crashing. Jeremy was saying, I can't watch anything about real estate without pure rage and anger overcoming my body. Okay, I appreciate you sharing. The market is going down. Bad time to buy is Interstellar's opinion. Has anyone ever joined a game of Monopoly, but the game started 50 years before you entered? If you have, can you tell me how you ended up doing? Yeah, I can definitely understand those frustrations, Jeremy, and you're certainly not alone. Depending upon the market you're in, obviously it's going to be more or less tough to get into. Depending upon the resources you have, I think that there are still ways to break into the Canadian real estate market, but specific cities like Vancouver, Toronto, Montreal, I think those are uphill battles and not likely to be, well, they're certainly not likely to cash flow, and they're definitely not likely to meet my personal fundamentals that I'm looking on investing in. I really like those cash flowing rental properties. But talking about inflation, talking about, rule changes, talking about what's going on in regards to core development and institutional buyers, and then talking about money laundering, all these things make me think that if we do see a softening in the Canadian real estate market, it's likely going to be just that, a softening, rather than a complete deterioration or market collapse. Now, this is ignoring things like black swan events. The world goes to hell in a handbasket. Absolutely, our real estate market will go along with it, I suspect. But barring those sort of crazy black swan events, I think that there's a lot of different reasons to see demand or a certain floor in regards to pricing. Now, that you may like that, you may not like that, but I personally think that that's the reality we find ourselves in. And I don't see a lot of those factors changing. I think inflation's going to be here to stay. In fact, I'm purposely adjusting my portfolio, not particularly real estate, but my other investments to plan for that, right? I don't want to sit on a lot of excess cash for extended periods of time. Not that I ever like doing that, but I even have more of a bias towards not wanting to do that in the current environment we find ourselves in. And then when looking at banking rules, Well, just the fact that CMHC would tell us things like, hey, we lost market share by making tighter rules or trying to, adjust for risk and adjust risk downwards. And it didn't work out well for us. We lost market share. So we're going to actually go back and adjust our rules now. If we can see that from CMHC, it seems likely that if people just want to keep buying, or if people turn to private lenders, that may still compel the institutions, the entire banking industry to want to, conform to consumers' demands rather than necessarily trying to adjust or protect ourselves from the inherent risk in what seems to be a very bubbly real estate market. Just a reminder, we did just share a stat that said real estate went up 24% in 1 year. That is not normal. That is certainly not sustainable, or I can't imagine how it's sustainable unless you're in Banana Republic, where it's going to constantly have, 24% like wage inflation in addition to 24% real estate inflation. But that kind of fits with the more than 20 or 25% inflation I think that Peter has seen in beef just this year alone. So again, interesting times. But I think inflation's here to stay. I think banking rules and CMHC, I think oftentimes they want to talk like hawks, but I think they're really doves or hawks or doves in hawks clothing. So I don't think that they've got the teeth to really go at the Canadian real estate market and try and adjust us or adapt us to any perceived risk they may see on the horizon. Core developments, I think, is just the beginning. I think we're going to see more and more companies moving into this space, particularly if money stays cheap, and there's a lot of it out there, particularly if the real estate market stays hot, or you can still get returns where you can find cash flowing rental properties. And I forget, I must have missed it somewhere there, but one of the other, I think, aspects about core investments as well to understand, and I think Ron Butler maybe said this in one of his Twitter threads, but is this company has to get 15% or like whatever their returns are. Let's assume they need to get 15% per year. Well, they need to get 15% per year every year. Unlike a small investor, you might be able to look on it on a 5 or 10 year horizon and be like, well, as long as, price appreciates at this rate and I can get a couple rent bumps at some points in time, this is going to meet my criteria. Where they've got much more strict criteria where they really need to get those returns quickly. That means they're going to go into, properties with a lot of potential or a lot of problems right now and turn it into the potential it could be. But that's also going to result in drastic increases in probably the average rent on their portfolio, right? I imagine they're going to be looking for similar returns to a lot of you guys when we're talking about the types of properties that we like to burr, right? They're probably looking for 20% or more equity or potential to create that when doing their investments as well. They're also probably going to be looking to take a underperforming asset and get it to market rents, right? And market returns. Again, that's going to create a lot of pressure. That's going to create inflation on the rent prices. And that's naturally going to attract other investors, even if they're not institutional investors into the market. And then I think also, unfortunately, money laundering is here to stay. And if you guys read that book from Sam Cooper, you'll probably even have a more intense perspective when it comes to money laundering. I know I definitely have a much better understanding than I did going into that book. In fact, over the last 10 years, my opinions and thoughts on it have really evolved to not really thinking or seeing it in real estate. I still don't necessarily see it directly. Maybe I'm just in small markets. Maybe I'm just blind and don't know what I'm looking for. But certainly after going through Sam Cooper's book, it became very obvious that there certainly is a serious issue in Canada. And, looking at some of these stats, if it's impacting the BC market in general from 3.7 to 7.5%, that is significant. You will notice that. So I think all these factors from just like a kind of macro perspective make me think that real estate's got a relatively stable floor when it comes to pricing, believe it or not, even though it seems insane because prices have gone up so much. Now, that doesn't mean you should just go blindly smash buy and buy the first piece of real estate that you can afford. I think you need to be more careful than ever, because the same way I was saying that, like, I think we've got a stable floor right now. If a black swan event comes, all cards are off the table, right? So again, I think that floor would deteriorate very fast because there are a lot of investors that are just counting on, the greater fool theory. They're hoping someone else will come along and pay them more money for the property they bought, even if they haven't really changed or tweaked it in any way. In fact, I know some investors that literally bought last year that they're sitting on 6 figures of equity this year and they've done jack squat, right? That shouldn't be sustainable, but who knows what's going to happen in the future. So while I don't think I see prices skyrocketing on the near horizon, unless we go into some sort of crazy hyperinflation scenario, I also don't see them dramatically dropping. So we'd love your thoughts, your opinions. Let me know in the comment section. I hope you guys enjoyed the fact that I'm back and doing the occasional live video. If you are, smash the like button, hit subscribe if you're new to the channel. And yeah, until next time, just make sure you're running the numbers and the fundamentals when looking at properties. I see so many people get into so many deals that I wouldn't wish on my worst enemy. And you guys are choosing to get into those deals. So make sure it all starts with understanding what you want as an investor, right? What is your prime goal, your prime directive as an investor? Is it cash flow? Is it, long-term net worth or equity, right? Are you trying to build up a nest egg? Are we trying to save up for a specific purchase, buy the dream cottage, pay for an education for a child, pay for a wedding, something of that nature? Again, the more details you have around what you're trying to accomplish, the easier it's going to be to find the right property for you. But don't let just what's going on in the market pressure you. There's a lot of real estate agents out there right now that do push a lot of FOMO on their clients or potential clients, maybe because that's just what they believe is going on in the market, maybe because it's in their best interest. We're all human at the end of the day, but make sure that you're making the right decision for you and your goals as an investor. You can't just blindly follow along with someone. You can't follow along with me just blindly, or core developments either, for that matter. So again, appreciate you guys, and we'll see you on the next video.